If you're acquiring an asset using borrowed funds, the interest on such borrowed funds will have to be expensed off in your statement of profit and loss, or it will have to be added to the cost of the asset as part of your financials. And is this principle applicable only with respect to the acquired assets or even for the constructed or produced assets? Welcome to Let's Learn IFRS series. In this episode, we will understand what is a borrowing cost and what is the treatment of borrowing cost in your financials. When an entity borrows debt funds with respect to a constructed asset or acquired asset or produced asset, and that asset takes a substantial period of time to get ready for its use, then such cost is called as borrowing cost. This principle is applicable to all assets, be it tangible assets or intangible assets, current assets or non current assets. The only condition that is applicable is the asset should take a substantial period of time to get ready for its use as intended by the management. One important point for us to note here is what is a substantial period of time is not defined by the standard anywhere. However, it is left to the management to decide as per its discretion. As per the general practice, 12 months or more is treated as a substantial period of time. Please note the debt funds borrowed with respect to the asset should be directly attributable to the asset, meaning without such cost, the asset will not be ready for use as intended by the management. Moving on to discuss the accounting aspects. The borrowing cost until the date on which the asset is ready for use is capitalized to the asset and it is depreciated over the useful life of the asset. And all the borrowing cost after the date on which the asset is ready for use is being expensed off to the statement of profit and loss. Even though IAS 23 clearly pronounces what is a borrowing cost and what is the treatment of borrowing cost, we will have to decipher the treatment of borrowing cost in line with IAS 2 and IAS 36. For instance, when it comes to the inventory cost, the total of inventory cost and the borrowing cost should not exceed its net realizable value because as per IAS 2, the carrying amount of the inventory shall be lower of cost or net realizable value. Similarly, the cost of plant and machinery and the borrowing cost should not exceed its recoverable amount, otherwise impairment loss shall have to be accounted. Hope this video gave you an overall understanding of IAS 23. See you soon in the next episode with another interesting standard.